Hello folks, and welcome to another episode of Financial QB TV. I am your host, Richard Reyes, the financial quarterback and investor coach. And of course, as always, this is the only place on the net where we care enough to tell you the truth. Now, I want to refocus on retirement and retirement planning. The weak 10-year track record of stocks means that it's really time for us to renew a focus on the economics of retirement. The math for planning for retirement is pretty simple. It basically is this. C, which is contributions, plus R, which is investment returns, equals your wealth. Okay? Put it simply, retirement wealth arises from contributions, whether from you or your employer, made over decades of work, plus the specific patterns of return during that period of time. A decade of depressed stock markets, however, that we've been through means that something else has got to give. Either we have to change our contribution side or we need to change our benefit side. Now, that is good, okay? On the downside, we know that we can't count on government programs or pension plans to provide us with an adequate retirement, because we know that the system is stretched to capacity. So we are it. What we save and how we invest and how we plan will determine what our retirement looks like. Instead of scaring you, this should actually set you free. You know exactly what you're dealing with. Now, let's start with contributions. The answer to weak returns that we could all use more of C. Okay, we know that the market hasn't returned that well over this short period of time, which means that, folks, we need to sock away more money. And a 401k type of retirement program, that typically means anteing up more of your income. This is particularly true if your employer has stopped making matching contributions into the plan because of the economic downturn. Of course, I know that all this is easier said than done in these economic times. The other option, though, if you do not want to increase contributions, is that you need to increase your period of time in which you need to make those contributions. Basically, you need to work longer. Working longer can mean, however, a higher lifetime earning from work, and ultimately higher retirement contributions. Working longer has an added element. You know, all things being equal, it means you have fewer years in retirement, so it means that you have fewer years that you need benefits from your retirement plans. Now, I do recognize that I sound like a killjoy, okay? One more year of work obviously means, all things being equal, that you get to enjoy or not enjoy 1 year at retirement, okay? But such is the math, which gives you kind of a triple bonus for postponing retirement, okay? You get more savings, more investment earnings potential, and less money needed at retirement. Now, the retirement formula leads me to another thought. In some ways, I'd argue that many Americans planning for retirement were misled by the exceptional stock market returns from 1982 to 2000. During those years, it seemed like investment returns would do much of the heavy lifting for you. Saving was something that was kind of an afterthought when it came to accumulating retirement wealth. It was very possible that we can imagine working for 30, 35 years, retiring in our 50s, and being in retirement for another 30 to 40 years. Today, with a more realistic view of what markets can actually deliver in good periods and in bad periods, the numbers look a little different. It's more about working maybe 40, maybe 35 to 45 years, and retiring for only maybe 20 years. Contributions need to be higher than many of us have imagined in the past. Markets averaged out over good and bad periods are now recognized to play a smaller role. So now, folks, there you have the new retirement math. See you next time on Financial QB TV.